Welcome back to the Daily Crypto Roundup. Today is Friday, December 26th, and this is your full, same-day breakdown of what is happening across the crypto market right now. As we move through the Christmas period, trading conditions are thinner, liquidity is patchy, and headlines can feel contradictory. That is exactly why shows like this matter more, not less. Markets are still open, capital is still moving, institutions are still positioning. And for anyone working, traveling, or trying to keep a clear picture while the noise ramps up, this is where we slow it down and put the pieces together. Before we go deep, here's a brief overview of what we're covering today. Bitcoin is holding just below key levels as holiday liquidity collides with one of the largest options expiries of the year. XRP is sitting near $1.87, showing a disconnect between institutional flows and on-chain activity. Altcoins continue to struggle as Bitcoin dominance rises and risk appetite remains muted. We've seen a major wallet security breach through a browser extension, reminding everyone that infrastructure risk never goes away. Institutional players, including BlackRock, are moving significant amounts of crypto on-chain during Christmas week. And in the background, the bigger structural story continues to build. Crypto is being pulled deeper into mainstream finance, with all the opportunity and friction that comes with that. And as it's Friday, it's the XRP giveaway. 10 XRP is going to Back for November, and 5 XRP is going to Obsidian. As always, congratulations to both of you. Drop your address in the comments and state if there is a memo for the wallet you use. If you want to be in with a chance next time, just leave a comment on today's episode. And while we're here, I just want to say a big thank you to everyone who comments every single day. The support, the discussion, the different views. It honestly means more than you probably realize. Seeing the same names show up, seeing new voices join in, and knowing people are taking the time to engage is genuinely humbling. This show doesn't exist without that interaction, so thank you for being part of it. If you want to be in with a chance next time, just leave a comment on today's episode. Okay, let's start with where the market actually is right now, because price always tells the first part of the story. As of right now, Bitcoin is trading in the high 80,000 range, just under $90,000. Ethereum is trading just below $3,000. Binance Coin is trading in the mid-800s. XRP is trading around $1.87. Solana is trading in the low 120s. Cardano is trading in the mid-30-cent range. Dogecoin is trading around 13 cents. And Tron is trading just under 30 cents. Now let's talk about what is driving this behavior. One of the biggest forces shaping the market today is derivatives positioning. We are coming into a record options expiry, with tens of billions of dollars worth of Bitcoin and Ethereum contracts rolling off. When expiries of this size approach, they tend to dominate short-term price action. Traders hedge, market makers neutralize exposure, directional conviction drops. That often leads to price pinning near key levels. Exactly what we are seeing now. This is why Bitcoin feels stuck. It is not because there is no interest. It is because the structure of the market incentivizes neutrality until the expiry passes. Once that pressure is released, price can move quickly, but predicting the direction in advance is extremely difficult, especially in low liquidity conditions. At the same time, we are seeing continued evidence of a risk-off environment. Bitcoin dominance remains elevated, and altcoins continue to struggle. A major market-making firm has gone as far as saying that the traditional idea of an altcoin season is effectively dead for now. That does not mean altcoins will never recover. It means that the conditions required for broad, sustained rotation into smaller assets are not present. Those conditions include strong inflows, expanding liquidity, and confidence that supply will be absorbed. Right now, none of those boxes are fully checked. Many altcoins face ongoing token unlocks and emissions, which create constant sell pressure. In a strong market, that pressure is invisible. In a weak or neutral market, it becomes the dominant force. This is why you are seeing a divergence between Bitcoin holding relatively well and altcoins bleeding or stagnating. Capital is consolidating in the most liquid, most established assets, rather than spreading out across the risk curve. XRP sits in an interesting position within this dynamic. On one hand, we are seeing continued growth in regulated products tied to XRP, including exchange-traded vehicles that now hold significant assets. That tells us institutions are interested. at least from a portfolio perspective. On the other hand, on-chain activity has not surged. Transaction counts, wallet interactions, and organic usage are not showing the kind of explosive growth that typically accompanies major bull phases. This creates a mixed signal. Price can be supported by institutional flows for a long time, but the most powerful rallies usually occur when institutional positioning and retail usage rise together. For now, XRP appears to be in a holding pattern, waiting for a catalyst that aligns both sides of the market. Now let's talk about security, because one of today's most concrete headlines is a reminder of how fragile parts of the ecosystem still are. A major browser-based wallet extension suffered a hack, resulting in millions of dollars in losses. This was not a protocol failure. It was not a blockchain exploit. It was an infrastructure issue, specifically tied to how users interact with crypto through everyday tools like browsers. This matters because it highlights a key risk that does not disappear just because prices go up. As crypto becomes more mainstream, more people interact with it through convenience layers. Those layers are often the weakest link. Even experienced users can be caught out by compromised extensions, phishing attacks, or malicious updates. The takeaway here is not fear, but awareness. Self-custody remains powerful, but it comes with responsibility. Convenience always introduces risk. Let's pause here for a quick word from our sponsors. Stay with us. Now let's zoom out and look at what institutions are doing, because this is where today's news becomes especially interesting. We have seen large on-chain movements from one of the world's biggest asset managers during the Christmas period. Significant amounts of Bitcoin and Ethereum were moved, sparking speculation about whether this represented selling, rebalancing, or internal transfers. Subsequent activity suggests this was more likely portfolio management than outright liquidation. Why does this matter? Because it shows that institutional players are active even when retail attention is low. They are not waiting for January. They are adjusting positions now, in quiet markets, where they can move size with less slippage and less attention. This ties directly into the broader trend we've been tracking all year. Crypto is becoming a space where traditional portfolio management behavior applies. Rebalancing, risk adjustment, exposure tuning. These are not behaviors of a fringe market. They are behaviors of a mature one. At the same time, we are seeing record levels of mergers and acquisitions across the crypto industry. Billions of dollars in deals have already been completed this year, with more expected in 2026. This is not happening because companies think crypto is finished. It is happening because they think the next phase will reward scale, compliance, and infrastructure. Consolidation is a sign of maturation. It often precedes a period where fewer players control more of the ecosystem, and where barriers to entry rise. That can be uncomfortable for early adopters. But it is also how industries stabilize. As crypto moves deeper into mainstream finance, it also attracts another familiar feature of traditional markets: legal friction. We are seeing a rise in private litigation tied to crypto assets, products, and services. This is not necessarily a sign of failure. It is a sign that crypto is being treated seriously enough to be argued over in court. Regulation, compliance, and legal frameworks bring clarity, but they also bring cost and complexity. For investors, this means the risk profile of crypto is changing. Market risk remains, but regulatory and legal risk are becoming more prominent. Understanding that shift is crucial for navigating the next few years. All of this feeds into the larger narrative that keeps surfacing in discussions about the future of crypto. As we head toward 2026, the conversation is increasingly about integration rather than disruption. Crypto is no longer something governments can ignore. It is large enough, interconnected enough, and visible enough that its stability matters beyond its own ecosystem. That does not mean guarantees. It does not mean bailouts. It means that crypto is becoming part of the financial landscape that policymakers have to consider. And when that happens, the rules of the game change. Markets tend to price these shifts long before they are formalized. That is why we can see periods where price action feels dull or frustrating, even as the structural groundwork is being laid behind the scenes. Quiet phases are often when the biggest changes begin. So let's bring this together. Bitcoin is holding steady in a fragile, low liquidity environment dominated by derivatives positioning. Altcoins are struggling because risk appetite is weak and supply pressure is constant. XRP is stable, but waiting for alignment between institutional interest and on-chain activity. Security risks remain real at the infrastructure level. Institutions are active behind the scenes, repositioning quietly. Corporate consolidation is accelerating. Legal and regulatory complexity is rising. And the long-term narrative continues to shift toward integration rather than isolation. This is not the loud part of the cycle. It is the structural part. If you are looking for fireworks every day, this period can feel frustrating. But if you are looking to understand where the market is actually heading, this is exactly the kind of environment you should be paying attention to. We will continue covering this daily, right through the Christmas period and beyond, because this is when context matters most. Drop your thoughts in the comments, take part in the XRP giveaway, smash like, follow, and we will see you at the top.